Today, Michaela is going to present on cash flow. So this is one that is very, very important. I think I have told many of you that cash flow is the thing I think of as the most important thing in managing our business. Before we get started today, I want to mention a few things. One, if I continue to run into people that have not listened to the Ranchonomics podcast, I would encourage you to do that if you're not already. The other thing is Tara Smith from Southeast Montana is hosting a kind of family leadership meeting in November. I do not have all the details with me right at hand, but it's the first week in November in Miles City. So if you live close to there, I would definitely look into it. And if you live far away and have family dynamics issues, you might look into it. There are a couple of us that are speaking there, myself, John Locke, and Emily Hobson. And if you've heard John or Emily speak, you know they're probably worth listening to. So with that, I think we will. Oh, and one other thing, if you've been in the habit of watching these webinars, I think most of you know there is a recording available of all of these on our YouTube channel. So please get on there if you subscribe to the YouTube channel and you get updates when we add stuff. So please feel free to do that. With that, I'll let Michaela start. So Michaela Griffin, thank you for coming today and thanks for presenting for us.
You're welcome. Glad to be here. I'm going to go ahead and share my screen. Make sure that y'all can see what I see.
Michaela, do you want questions as we go, or do you want people to save them to the end? What would you prefer?
I think as we go would be best.
Okay. And if you're in a noisy environment and want to add them in the chat, I'll try to keep an eye on that and make sure we get those caught up as we go.
Very good. Sorry, I'm just trying to get my slides on the right screen here.
It's all right.
There we go. That'll work better.
You're a chair back. Malachi's doing something.
John, I'm not able to see the chat or anything, so if you could kind of help me.
Okay. I'll watch it.
With anything that comes up there.
You bet.
And can you see my pointer here?
I cannot. Can anybody see Michaela's screen share?
Try again.
Not yet.
There we go. It's coming up.
Okay. Thank you.
There you go. Title slide.
Okay, very good. So if you've been able to join us for the past few webinars, we took a little break last month and talked to Land Trust. But prior to that, we've been talking about the financial statements and getting back to the basics, really understanding those statements and how they can help us make decisions in our business. And so today, for this webinar, we'll briefly recap those previous webinars with the balance sheet and the profit and loss statement, but the majority of today's webinar will be about the cash flow statement. And we want to talk about the mechanics of the cash flow statement, the format, how it's laid out, how it works, and specifically about the power of cash and what it can do for us in our business. So we'll start with the balance sheet. These are going to be just basic definitions that y'all have all heard 100 times before. But I just want to quickly go over them because they relate to the cash flow statement. So when we talk about assets on the balance sheet, we're talking about any of the resources that the business owns or controls. We've got current assets, and those are expected to be used, sold, or converted into cash within the normal operating cycle of the business. And then we've got long-term assets, also called fixed assets. And these are the resources that the business can use over multiple years. On On the other side of the balance sheet, we've got liabilities. Those are debts owed to others. And of course, debts must be repaid. And within liabilities, then we've got current liabilities and long-term liabilities. And the difference here is just that current liabilities are expected to be paid within the business's operating cycle. Oftentimes, that's about 12 months. And then the long-term liabilities can be paid over time. And they should always be used to purchase long-term assets. So because those assets are spread out over multiple years, the liabilities can be spread out over multiple years also. And then the last big section on the balance sheet is equity. And that's the portion of assets that belongs to the owner after all debts have been paid. So we remember the assets is on one side, and within that, we have a certain percentage of those assets that are owned by investor dollars or owner dollars. And then there's also a percentage, usually there's a percentage that is some debt. So if you think of your assets as 100%, a certain percentage of that would likely be funded with liabilities, and the rest of that would be funded with owner investment. You can think of the assets on a balance sheet like the parts of a vehicle. They all work together. Maybe not all of them are totally necessary, but they all play their part in making the vehicle unique and making it run. Next, we talked about the profit and loss statement. At the top of the P&L, we have gross product, and that measures the total value created, and that includes sales or revenue. And then out of that, we subtract out any inventory purchases, and we account for any other non-cash value that was created. So that's kind of a technical way of saying that we're just trying to account for all the value your business creates, whether it's actually been turned into cash or not. Next, we're going to see the expenses on the P&L, and they're separated into direct costs that are directly tied to each unit of production. An increase, as you increase your units of production, your direct costs are going to increase at a similar rate. Overheads are the expenses that aren't very easy to allocate to a particular enterprise and just generally serve to help the business operate. Those are the things that don't change very much, even when you increase your units of production. And then I'm cheating a little bit. I'm going straight to the bottom here to net income. But really, net operating income and net income are often very similar. They're both measures of profit. The only difference here is with net income, which is your true bottom line. We've also got other income and other expenses. These are things that typically wouldn't be related to the business operations, or things that may occur just irregularly. And we at Ranch Right focus primarily on the other expenses and often include income up here in gross profit to get a true measure of the value that was created that year. So if the balance sheet tells us what's under the hood, then the P&L tells us how much horsepower the engine produces. As profitability improves, the business runs faster, more efficiently, and carries you further forward towards your goals. And that brings us to today. We're going to talk about cash flow and the cash flow statement. We'll specifically drill in on the difference between profit and cash, talk about the different types of reports you can use to get this information for your business, and then we'll end on what cash can do for you. So if the assets of your business are like the parts of a vehicle, and the engine is like the profitability. Then the fuel for that engine is cash. Just like every vehicle needs fuel to power its engine, every business needs cash to be able to operate and create profit. So this brings us to our cash flow statement. The cash flow statement tells the story of how cash moves into, through, and out of your business. And I like to think of it as telling a story because anytime I look at the cash flow statement, um, you'll see when we start going through examples that everything is tied together. So when you see a move on the cash flow statement, whether it's positive or negative, there's always a story behind that. I sold some cows, or I sold some calves, or I purchased a tractor, or I got a loan, or whatever it is, there's always a story behind it. And the story is going to be organized into 3 sections. You've got operating activities, that's like the actual operations of the business, investing activities, and financing activities. And investing and financing are going to be in support of that main operating business. These categories are summarized by net cash change and ending cash. Now, I like to think of it backwards, and you can tell me that's crazy. But back to the idea of this being a story, it's helpful for me to understand it just like a business getting started. We tell the story of a business getting started. So, with every business, there's going to be an initial inflow of cash, right? Whether that's you get a loan from a bank to start your business, or a lot of times you just put in your personal savings to start your business. Either way, that's either going to come in through borrowing or owner investment. So that's cash coming into your business. It's going to hopefully end up in a business checking account. So anytime you think of your business being funded, whether it's at the very initial investment or anywhere along the way, if you need to inject cash into your business, that's going to show up here as a financing activity. The other side of that coin is once the business is operating, creating profit, at some point it's going to be time to repay the lender and eventually repay the business owner. When this happens, cash is leaving the business's checking account and it's going to decrease that balance. So within this one section of financing activities, we'll either see an increase, that's funds coming in, or a decrease, funds going out. In the cash flow statement, you can see right up here at the top, we're looking at a specific period of time. And these numbers over here on the side are showing us the change that occurred in that period of time. And for financing activities, we're always going to be looking to the balance sheet for those changes. Specifically, we're looking for any change in equity, that would be the owner's money, or change in liabilities, borrowed money. And remember, within liabilities, we can separate that out into current and term, depending on what you're using to buy that for. Let me know if you've got questions about any of these specific sections. For investing activities, we're going to be thinking about purchasing long-term assets or selling long-term assets. And this also to me is pretty intuitive. If you're thinking about the business getting started, you're going to have an injection of cash in the beginning, and then many times you're going to be purchasing long-term assets. Sometimes that may be breeding stock, sometimes it may be equipment. Either way, you're going to be putting that money to work in an asset that you know will produce profit. So when you're investing, You're purchasing those assets and that cash is leaving. Okay, so you just put your cash in through financing, and then now your cash is leaving again through the investing activities. At some point along the way, you'll likely be selling some long-term assets, and we know when you sell your assets, you're going to get a check for that, and when you deposit it, it will increase cash. So I hope you can see here how telling the story behind your transactions and the moves you're making in your business can help you kind of categorize that in your head, which type of activity this is and how that affects cash. The investing activities are also tied to the balance sheet. Specifically here, we're looking for any change in long-term assets or fixed assets. And a lot of times these move together. So if you, let's say in this case, yeah, you can kind of see these numbers here that are grayed out. In this case, if we have an investing activity of $50,000, that might be $50,000 worth of cows, breeding age cows. And if we had cash from investing activities coming into the business of $25,000, that might be $50,000 worth of cows that were bought using $25,000 worth of borrowed money and $25,000 worth of our own money. And this brings us to the last section here, which is also the top, operating activities. This is arguably the most exciting and important part of the cash flow statement because this is the cash that's actually being generated by the business. This is the really healthy part of the cash flow statement, or at least we hope it's healthy. If we're seeing a big cash increase here, that means the business is creating value, turning it into cash, and any increase in operating activities here is going to flow down to our net cash change, hopefully, and then hopefully increase our ending cash, and we'll actually feel the benefit of that value, that profit that we created in our business. But occasionally, if things don't go as well as we hope, the business may actually use more cash than it generates. If we're looking at a big, like a year-long statement like this, January 1st through December 31st, obviously we hope that the business is going to generate more cash than it uses. But the other way to think about this is if you're looking at it on a shortened time frame, like maybe month by month, I think there's many businesses in agriculture that use more cash than they generate in any given month. Lots of us get paid just a few months out of the year. We kind of get all of our cash at once, and then we have to piece that out for the rest of the year. And this is where we would see that happening in operating activities. Depending on the time frame we're looking at, we would likely see a big jump for certain months, and then in other months we might see a negative number there as cash is being used. And this operating activities line primarily comes from the profit and loss statement. It starts with the net income or loss for this period, and then we make some adjustments from the balance sheet. Those adjustments are the change in inventory, which with Ranch Right we actually see on the profit and loss. But even if we didn't have that inventory change there, we would be able to see it on the balance sheet. And that change in inventory is value created, or if it decreases, value lost. But hopefully it's increasing, and that would be value created but not sold. We've got accounts receivable that we would use to adjust the net income, and that accounts for any income that's delayed. So you might make a sale, but if you don't get that money right away, maybe you get it in 30 days, it would show up on the profit and loss as income, but it would actually be delayed. And then the other sort of matching account there is accounts payable, which is the same way, just with expenses rather than income. So in this case, you have a delayed expense rather than the delayed income. So to summarize, the operating activities is reflecting what's going on in the day-to-day operations of the business. The value that is being created and turned into cash with a few adjustments so that we can see how that cash is actually moving through our business. And the whole story is summarized here in net cash change. It sums the operating, investing, and financing activities. It is specific to the whatever period we choose on the report. So this example is for 1 year. So this net cash change is representative of that time period. And then it's added to beginning cash down here at the bottom. So we just add this net change to the beginning cash, and this should match the cash that we have in the bank account. This leads us to our first key takeaway today, and probably the most important takeaway today. This net cash change is not the same thing as profit, and the profit on your P&L is not the same thing as cash. And I'm sure that's intuitive. I know that y'all have felt that in the past. In fact, we hear it pretty regularly. Have you ever looked at the profit on your P&L, that bottom line net income, and wondered, where is it? Where is my profit? Where did it go? Why isn't it in my bank account? And we've got a couple very specific variables that make that happen. There's nothing wrong with your P&L, nothing wrong with your bank account. This is actually the key purpose of the financial or the cash flow statement is to help us track that cash movement, and we can see the differences between the profit and the cash by thinking about this equation for net income. So gross product, direct or less direct cost, less overheads is how we get profit. So what about our gross product could create a difference in the value that it's showing and the actual cash that hits our bank account? The first is inventory growth. So we increase the value of our inventory, whether that's calves, breeding stock, frozen meat, grain, hay, all sorts of, and I say calves all the time, but I don't mean to leave out my sheep people. Any market livestock would be included in this. So even though there is an increase in value that's being created, until it's sold, there's no cash inflow. Sales with an invoice. This is the same thing that we were just talking about with accounts receivable. We sold valuable goods. That's reflected in our revenue line. But because the cash was delayed, because we gave the purchaser 30-day terms or 60-day terms, that cash inflow has been delayed. And then let's think about our expenses. And I've just lumped direct costs and overheads in here together because they can be treated the same way. For either direct cost or overheads, you likely make some purchases with bills, meaning you go to a store or a supplier and you make a purchase and they send you a bill. When that happens, you have an incurred expense, but you've actually delayed your cash outflow for a certain time period, often 30 days. So your P&L will reflect the expense whenever you made that commitment, whenever you incurred that expense, but your bank account doesn't change until you've actually paid the bill. And then finally, for the sake of managerial accounting and understanding the real economics of our business, we include non-cash expenses on our P&L. These are things that have a perceived cost, but no real cash outflow. So some really clear examples of this are opportunity rent, like if you own the land and you have to pay rent to others, but you don't pay rent to yourself, we can still include that as opportunity rent for the sake of acknowledging the cost, that opportunity cost. But of course, that doesn't change our bank account. Same thing with deferred wages. Sometimes we see it with internal feed or internal hay use, things like that. So all of these things change the P&L, but we don't see the corresponding change on our cash flow statement and in our cash accounts. Okay, so this is where we're going to pause for a second. And we can do this, y'all can either volunteer and chime in, or if you're feeling quiet today, I can give you some examples. But I'd like to give you a cash example, like purchasing calves to put on feed. Can anyone think of a similar example, like getting calves on feed, but something that wouldn't actually impact the bank account?
Yardage in your own yard if you're not charging yardage.
Okay, yeah. Yeah, that would be a non-cash expense for the feed yard. So to get the calves in the feedlot, I know some people on this call have stockers that they transfer into their feedlot. And then yes, Treg, the example of yardage for your own calves is very similar to like the opportunity rent. So purchasing breeding cows would change your cash. Can
Holding
anyone
over
think?
heifers to breed.
Yeah, good. So either transferring heifers to breed or even just like revaluing your cows on different ages. So as they increase in age or as they get pregnant or open, just depending on how you want to revalue those cows, we know their value is fluctuating all the time in your inventory. So anytime you're adding value like that, but no cash is changing in your account, that would be that non-cash difference. Okay, so we've got buying feed, actually like going to the store and getting a bill for feed. Treg, this reminds me of your example. If you got your own feed yard, I know we have some people who grow their own feed and they grind their stored grain into feed. So here we have a very obvious cash outflow, and here there's no cash moving. We're just moving feed from the grain bin, grinding it and putting it in the bunk. Okay, for another cash expense, we've got selling hay. What would be the non-cash version of that?
Feeding that hay.
Exactly. And I like this example because it actually works both ways. On the actual like expense side of it for your livestock, if you're feeding it, that's a non-cash expense. But it also works the same way with your hay enterprise. If you feed the hay, you're not going to get the revenue from it, right? So we do an internal adjustment so that we can account for that revenue. Another cash example is selling calves at the sale barn. And this one's a little tricky, so I'm just going to go ahead and give it to you. But selling calves private treaty, where we're expecting that revenue, it is going to be cash very soon. But if you send them an invoice that's due in 30 days, there's a good chance that you won't get that cash for 30 days. The use of a line of credit to pay rent. This goes back to the example that I used previously with the opportunity rent. Financing a tractor. This one to me is a little bit counterintuitive. If you finance something, especially if you finance it 100%, you might not feel that cash movement in your business. But the way the cash flow statement works is we would see it show up as a financing activity and an investing activity. So we're using long-term dollars to purchase a long-term asset. So that's cash flowing into our business and then immediately flowing back out as we make that purchase. And then adding a vet bill to accounts payable, that would be like getting a bill from the vet. It says it's due in 60 days. So we add it to our accounts payable and make a plan to pay that before it's due. But at the time that the expense is incurred, it is non-cash. And then another really important one that often gets overlooked is making a loan payment. So if we're financing any long-term assets, whether that's equipment, livestock, land, anything like that, we need to plan on that cash outflow to actually make that payment. So what do we do with this information? There's two main things. The first, we can account for past profit. We can look at our P&L and we can say, where did my profit go? So in this example, we said our business generated $100,000 worth of cash. We spent 50,000 of it on some kind of long-term asset. And then we got $25,000 worth of financing. So if we go back to that tractor example, we can see that we put $100,000 into our account. The $50,000 went out of our account to buy the tractor, and the $25,000 came into our account as a loan, a long-term loan, which means the net cash change in our cash account would be $75,000. If we add that to our beginning cash, that gives us our ending cash. And this is a perfect way to make sure that we've got all of our financial statements lining up, because all this information flowed from both the P&L and the balance sheet. So when the ending cash matches your bank statement, that's a great sign. This creates clarity in that difference between profit and cash. And I will say that this often lives in producers' heads. So speaking from experience, it's easy to just say, I know what cash or what checks I've written. I know the difference between the value I've created and what hasn't been sold yet. But when it just lives in your head or lives in your check register, it can create a mental load. And eventually, when you make enough transactions, you'll start making errors. So that's why this cash flow statement can be really beneficial for reducing that mental load and having it spelled out very clearly here for you, where your money is moving. The next thing we can do that's really important is project future cash. So just like we can say, where did my profit go? We can decide, where will my cash go? If we can estimate future cash inflows and future cash outflows, we can do this calculation that shows us where our cash should end up over different periods, whether you want to do that quarterly or monthly. It's really useful to do those projections. It improves accuracy, provides peace of mind, and very importantly, it empowers your business strategy. So we've talked about in the past how the P&L helps you build your strategy. The cash flow statement is going to be the thing that actually empowers you to, well, I should say cash flow specifically is going to empower you to implement and execute your business strategy. Are there any questions before we leave this slide about the cash flow statement or those sections?
Somebody's got to have a question. Come on, you followed this perfectly? I know Andrew did.
I'll give you a little more time to think of
I
questions.
can't believe there aren't any questions.
I'm sure there are.
So with the financing part, where would that show up as a negative or whatever, I guess?
Yeah, good question. So anytime it's negative, that's signaling a cash outflow. So for financing, that would be debt repayment or owner distributions. That would be
Well,
cash.
didn't you said or the 25,000 there?
Yeah,
You said that was a loan, right?
right. Money coming
So
into the business as a loan.
so where is that at? Yes.
Help me understand the
So
question a little more.
yeah, I guess that's got to be a liability somewhere because it's a loan. So
Right.
where does that show up at?
The balance sheet. So if
The
this
balance sheet.
$25,000 here, if we ran a balance sheet for January 1st through December 31st, this $25,000 would show that our long-term liabilities increased by $25,000. That's a great question. If it was negative, that would be a decrease in our long-term liabilities of $25,000. And like the longer we span this period at the top, the more inflows and outflows we're going to have. So I do think it's useful to break your cash flow statement down into smaller chunks, whether that's quarterly or monthly, so that you can see more clearly, like in June, I got a $50,000 loan, but then in August, I made a $25,000 payment, and the result then was $25,000, if that makes sense. Like this is the cumulative change for this entire period. So the more you break it down, the clearer it will be. Awesome question.
And you mentioned that you think doing this at least quarterly and most likely monthly. For some people, we need to do it weekly, right? We need to make sure we have got cash and cash reporting at the level that our business requires.
Yes, that's a good point. Like this difference in accounting for past profit, that may be more of a quarterly or monthly strategy.
Yeah.
But projecting future cash, if your business is very cash intensive or just has a lot of cash moving around, weekly could absolutely be beneficial.
Yeah. So imagine you're running the Joplin sale barn and doing a quarterly cash flow projection, right? That's going to be a complete disaster. Whereas if you're running a cow-calf operation, that's very low cost with one transaction a year, then you might be able to get away with that.
Right.
Okay.
Okay, so continuing with this idea of using each statement, each report for its intended use and exactly what it can provide for your business. If we think about the profit and loss statement, it's reporting the profit creation. So think of that as like the total value created minus the expenses that it took to enable that value creation. That's literally the profit that's left. The cash flow statement reports cash. And as we've already talked about, we know those things are different. They're different things. The profit and loss statement, while it can be segmented by time, it's very useful to segment it by enterprise so that you can see each enterprise's contribution to your business as a whole. Compared to the cash flow statement, which isn't as useful with enterprises because at the end of the day, you've got to account for all of the cash moving through your business, not just for any particular enterprise, but it is very useful to segment it over time, which we've already talked about. And then this kind of created an aha moment for me in the past. The profit and loss statement is very useful for analyzing your performance and building a strategy for improving performance going forward. So looking at things, important metrics like overheads, gross margins, and particularly gross margins by enterprise can help you see which enterprises are really moving the needle, which ones are really pulling the weight and helping you cover your overheads and create additional profit that turns into an increase in equity. So you use the profit and loss statement to build a strategy that's going to work for you and your business. And then the cash flow statement is the thing that empowers you and enables you to execute on that strategy. So think of it like this. You could have the best, most profitable strategy in the world, but if you don't have the cash to actually buy the inputs and fund the operation, you go nowhere. Same as a a sports car that has a very powerful engine. If it has no fuel in it, it can go nowhere. So we use the P&L to build the powerful engine, and then we use the cash flow to make sure it never runs out of fuel. So what do we do next? This is where you get to choose your tool. We've got two main reports that I'd like to talk about today and just talk about the differences with these reports and how they serve different purposes. So we've got the QuickBooks Statement of Cash Flows and RanchRight's Cash Flow Planner, which RanchRight's had for a long time, and we've recently been making some updates to that, some upgrades, and I'd like to share the difference here in both. So with QuickBooks, because all of the transactions that we put into QuickBooks help us measure the economic impact of those transactions, meaning we want to account for all the value that's being created, and we want to account for all of the expenses, even the non-cash expenses or the opportunity expenses. Like for us to get a true picture of the economics of our business, we treat QuickBooks as we use QuickBooks for managerial accounting. So as a result, any report that you pull from QuickBooks, whether that's the P&L or the cash flow report, is going to have an economic perspective. This is great for understanding the creation of value and how you convert that into cash, and also the opportunity costs that go with that. But it's less clear for understanding real cash in and real cash out. And I'll show you what I mean. With RanchRight's Cash Flow Planner, we report cash flow as real cash movement. So specifically, we're not including like the change in inventory value in our cash flow planner because it's not real cash moving. We would use the P&L to account for that change, but we're not using it on our internal cash flow planner. What that does is it simplifies the numbers and boils it down so that we can have a very clear understanding of liquidity and financing needs. The thing that loses is that value creation. So because we're not valuing inventory or other non-cash items, you'll still want to lean on your P&L to understand the full performance of your business and all the value that's being created. So let's do some examples. And I hope that this is not just totally overwhelming. I thought about not doing this, but then I thought, if y'all want to go back and see these examples, it might be helpful in the future. So forgive me if this is just too much data at once, but I hope you'll ask questions if it seems unclear. So if you sell mature cows for $10,000, in our head, we know that when we sell cows for $10,000, our cash account is going to go up by $10,000. So I'd like to show you the different ways that these reports show that cash movement. On the profit and loss, this is in QuickBooks, it'll show $10,000 of revenue, and that will be offset by the $10,000 of inventory change. So because we took $10,000 worth of cows out of our inventory, took them to the sale barn, we have $10,000 worth of revenue, but we have $10,000 less of cows. So the result there is no change in net income. On our balance sheet, we see that our cash increased by $10,000 and the breeding herd decreased by $10,000. So the way those two things flow onto the cash flow statement, we have zero change from operating activities. So our net income that flows over will stay zero, but we're going to have $10,000 from investing activities. So Treg, you talked about that negative versus positive number here. Here we're going to see a positive cash inflow that comes from the sale of fixed assets. So when we take this 0 and add 10,000, that's going to give us a $10,000 change. Now here's the translation of all these numbers. This is just plain English. Because this transaction, selling $10,000 worth of cows, we did not create any value in that transaction. We simply converted existing value into cash. So your cows already had that value, you had already done the work, and it was showing up in your inventory. But just converting that inventory into cash did not actually generate any additional value, which is why the net income shows up as 0. And then this is the way the Ranch Right internal cash flow planner would handle it. We would see an increase in revenue of $10,000. That's literally the only thing we would see, because we do not account for any livestock inventory change. So really plain and simple, your net cash change then is $10,000. And the translation there is you created $10,000 of revenue, and we just intuitively know that that increases your cash by $10,000. So if we see an example of this, this is the statement of cash flows from QuickBooks. Here we can see that we didn't actually create any value here in net income because the value already existed. Rather, we took these long-term assets and converted them into cash. So Treg, here is where we see a positive $10,000 here because that's cash coming into our business. And so that net cash increase for the period then is $10,000. When we add that to the cash at the beginning, we get the ending cash here. Alternatively, the Ranch Right cash flow planner shows revenue of $10,000, but because we're not worried about tracking the inventory value, we just let that flow straight down to the bottom where we see the net cash change of $10,000. So to be very clear here, neither one of these reports is right or wrong. It's just how you prefer to consume this information and what questions you're trying to answer. Either way, you're going to come up with the same cash balance. Okay, so we know this is an example of an actual cash transaction. Now let's look at an example. This is my last example. I promise I'll stop throwing numbers at you after this. But this is the cow herd appreciating by $25,000. So we know this is an example of a non-cash event. No cash is changing hands here. We just know that our cow herd is appreciating or has appreciated by $25,000. And that could be by breeding them. It could be by putting weight on or getting them to a certain age. Like there's a lot of different ways you can add value to your cows. Regardless of how you do that, we want to account for this value creation. So this one's a little bit more straightforward. On the profit and loss, we're going to record $25,000 of inventory change. In this case, it's increasing your inventory. And that raises your net income by $25,000. On the balance sheet, we see that the cow herd has increased in value by $25,000. And when these things flow onto the cash flow statement, this is a little bit abstract, so bear with me. We're going to see the $25,000 from operating activities. That's net income. And remember, this net income is the value created. Like when you created this value by doing something that made your cows appreciate, we're seeing that in the business day-to-day operations, an increase of $25,000. But because our cow herd appreciated by $25,000 on the balance sheet, it's essentially the same thing as having more fixed assets. So it's offset by $25,000. And what you come up with then is $0 in cash change. So we'll see an example of this in the QuickBooks report. But the main thing I want to show you here is if you open your QuickBooks report and it doesn't look like what you expected it to look like, I hope that you'll be able to come back to these examples and see if maybe something like this applies. You're always welcome to reach out to anyone on our team. But I just don't want you to just automatically think that it's wrong. It's just an interesting way to account for value creation. So the translation here is that you did create $25,000 of new value that shows up on the P&L. But the important distinction is that that value exists in the form of cow inventory rather than cash. And this might be a good time to mention, I think anyone who owns cows has seen a massive appreciation in their herd over the past few years. And if there is no conversion event, if you're not converting that appreciation into cash, you will only see that increase on your balance sheet and it will never hit your cash account. So I think we all understand that intuitively, but this is the mathematical way that it shows up in our books. We see that increase on the balance sheet, but as long as it exists in the form of cow inventory, it really doesn't do us much good, right? Like it's equity on the balance sheet, but we can't do anything with that value. So for the Ranch Right cash flow planner, remember we do not account for any livestock inventory change. So we have, it just doesn't show up at all. It's just net cash change is 0. And the translation here is crickets. You won't see anything on the cash flow planner. It never lands on the cash flow planner because we are only interested in tracking cash creation, not value creation. So here are these examples side by side. This is the statement of cash flows where we can see that the net income was $25,000. We created that income, or that value, I should say. And then this is the change. Remember, we're measuring any change in our long-term assets. So because our value went up, it's showing there as a negative number. And that confirms that we did not have any cash increase for the period. Then we see that there's been no change here in our cash. So in this example, the previous example was February. This is March, where we have no cash change and we see the same balance here at the end. There's a couple other things I'd like to point out about our internal cash flow planner. It does match the same 3 main sections with operations, investing, and financing. It's segmented by time, just like the cash flow statements in QuickBooks. And the net cash change helps us project the ending cash. And this is where our internal cash flow planner may be extremely useful for a lot of people, I think, is we're not just looking in the past, we're also looking forward. So we do have lines here for the actuals. And those actuals, when we compare those to our past projections, so comparing January's actuals to January's projections, shows us how accurate we are. And I hope that over time, as we measure these things and track these things, that we can project forward with better accuracy. The other thing it does is because we're able to project forward, and this is just showing 2 months, but typically we would like to see 12 months forward. We've been looking 3 months back, 12 months forward at any given time. So because we have those future projections, we can see, is our cash improving? Like I think all of us would be able to say very quickly whether or not we feel cash flow pains on a regular basis. And I think probably a lot of people do. So the goal with this cash flow planner is that as you're able to project forward and plan for cash creation in your business, that cash flow will improve, and that improvement in cash flow can do a lot of things for you, which we're going to talk more about in just a second. So just to summarize this point here, we've got 2 main tools for analyzing our cash flow. Both may be right for you at any given time. It just depends which question you're trying to answer. QuickBooks offers a deeper analysis with value creation and cash conversion. So it's going to show you, did you create value and did you convert it into cash? So right now, when cattle are high and have been getting higher for several years, we're going to see a lot of value creation. But unless you're actually turning your cows over or liquidating any cattle, then you're not going to have that cash conversion. So the questions that this tool can answer are, of the value I created, how much did I turn into cash? And is the value of my inventory increasing? Ranch Right's internal cash flow planner offers a more simple, straightforward information that helps when managing liquidity and financing needs. So if you can imagine, like if you're looking at how much rent you need to pay over the next year, or you're planning for your crop inputs and rent and things like that, it's helpful to be able to kind of cut out the noise of opportunity rent or non-cash expenses and be able to say, I have X amount of expense that is cash expense that I need to be able to finance over the next year. And then you say, I have X amount of cash, and it becomes a very simple equation. Do I have enough cash or fuel in the tank to actually empower the strategy that I want to move forward with? So the questions this tool can help you answer are, how much cash should I create? How much cash do I need to operate? How accurate are my projections? And is my cash flow improving over time? Will it improve over time? Okay, so as we move to the end of our webinar today, let's come back to this idea of how powerful cash can be. We've got two main things that cash can do for us. We've got defense and we've got offense. So for the defense, we're trying to reduce risk. When we have cash in the bank and when we have cash coming in, that turns emergencies into simply inconveniences, things that we can manage. It buys us time to think instead of react. And it can give our operation resilience and steadiness, even in the face of market inconsistencies. So particularly when prices are high and emotions are high, it's really great to have cash in the bank to help ground you and keep you steady and keep your operation steady, even when the market's being crazy. And then it can reduce our dependence on lenders and interest rates. This helps us make our own decisions, and when you're financing your own operation, nobody can tell you what to do. So this is the way you can truly empower your strategy and your business and your family, when you can increase your cash in the bank. So the next part of this is offense. We want to be able to seize these opportunities, and we know that opportunities often come and go quickly. So when an opportunity appears, a lot of times we never expected it to show up, but there it is. We need to have the cash in the bank to take advantage of that. Having cash in the bank also builds credibility with lenders and partners and gives you the opportunity, particularly if you're looking to invest, would give you the ability to provide a down payment or things like that. Back to that opportunity of back to the idea of taking advantage of the opportunity. You can fund growth on your own term and not the bank's. You get to decide your strategy, and if you have the cash to fund it, then you get to make the decisions. It also keeps you nimble so that you can pivot when others are stuck. A lot of times with the banking situation, if you're overly dependent on lenders, particularly for input costs and like that, the actual operations of your business, they can be kind of picky about what you do, and they can give you some regulations that you've got to stay within, and that takes some options off the table. So when you have cash, it empowers you to make more of those decisions. And then when you have strong cash flow, not just cash in the bank, but actual cash flow, it creates momentum for future profit. So the more cash you have today, the more you can reinvest in your business, you're funding your own operation, you're taking advantage of opportunities. All of those things work together to build momentum for your business. And this is more of a summary of the last several webinars, but we have a team of reports here. And as I was preparing this webinar and thinking through how these reports connect, I heard someone say that the profit and loss is the most selfless report. It just gives information. And the cash flow statement is the most selfish report because it just takes and takes. It doesn't give any information. And the balance sheet, I guess, provides the balance. It's somewhere in the middle here, where it's both getting information from net income and also giving information about its change in accounts. But the important thing that I think this really brings us to is that these reports are a team. If you're overly focused on equity, you're going to be missing the big picture of profitability and cash flow. If you're only focused on profitability and building that strategy, you may miss the inevitable cash crunch. You may not be able to see that coming. I think it's so important, and it's more clear to me now than ever how important it is to see all three of these reports in balance and see how they work together. And I really think if you can understand the cash flow statement, the other two statements will just fall right into place in your mind. And if you're using all three of these, then you are definitely driving your business. You're not just tracking the past, but you can drive it forward with confidence. So in summary, make sure that you have the right parts on the balance sheet. Use the P&L to build a profitable, powerful engine, and then make sure you keep your tank full by creating a strong cash flow with the cash flow statement. And if our team at RanchRight can help you with any of these things, please reach out to us, and we would love to be a help to you.
Awesome. Good stuff, Michaela. Thank you. Couple of quick comments and questions in the chat. Josh asked, where do we find the RanchRight cash flow planner?
So right now we're preparing those for people as needed. So if you'll just reach out to us, either your bookkeeper or you can send me an email, and we will we'll get you started with that.
Very good. And then Joy and Rick, I need you to clarify. You're talking economics versus finance. You're giving us some help here on thinking about cash versus our cash flow versus our P&L. Is that right? Maybe they're still here.
Yeah, that's right.
Yeah, very good. Okay. You want to add anything to that?
No, it's just the strategy part of it, right? Once you actually know where you're at, then you can, what you want to do rather than as compared to what you can actually finance or what you can actually pull the trigger on.
Yep. Very good. And to put a point on what both of you are saying here, the majority of businesses that fail because of cash flow. So 85% of small businesses fail within the first 5 to 10 years. And it's some ridiculous number of those fail not because of a profitability problem, but because of a cash flow problem. So very good. And we've all had that feeling of, man, I made a ton of money this year. Why don't I have money in my bank account? Like, sheesh. And there are other times if you're going into a drought, for example, when you can have a lot of cash and not be very profitable. And that's a very different situation. We do see those also, but we want to be very careful we understand the why. All right. Any other questions or comments? Michaela, thank you very much for being our presenter. You can find her email on the web if you want to email questions. It's on our website. If you If you have other comments, please feel free to leave them. We would love to sort of figure out what is working and what isn't. Michaela, do we have a plan for next month's webinar?
Nothing specific yet, so
Okay. We will announce that in a couple of weeks. Very good. And again, we'll be back next week on the third Thursday of November. So that'll be, I think that's a full week before Thanksgiving. So look forward to seeing you then. Thank you all for coming, and I hope you are having a wonderful week. We'll talk soon.
Thanks.
Thank you.
You
thank
bet.
you.